Hello everyone and welcome to Last Week on Wall Street, where I dive into some of the biggest stories from the world of finance that happened this last week. We have a fun episode prepared for you today, but before diving into that, if this is your first time on my channel, then hey, my name is Galbraith. I'm a finance professional here in New York City. I post daily on this YouTube and across the different platforms, so definitely subscribe to the channel. And with that said, let's get into this last week on Wall Street. All right, it is crazy that it is already July, so we are going to be talking about June 24th to the 28th. Some of the topics that we're going to be covering today are the French elections, some more inflation numbers, as well as a big IPO that a lot of people are looking at, and that is with Shein. And then also still looking at geopolitical news, we have the UK election and how that might affect the private equity payout for certain firms, and finally, the Pershing Square potential IPO. With that said, let's get into it. First up, the personal consumption expenditures index. So this is a really interesting graph. Here it shows that the May reading was a 0% increase month over month, but it was 2.6% of an increase year over year, which was in line with median expectations. And this is not a good thing, it's not a bad thing, but it's kind of just what was expected. So this does show that monetary policy is working and inflation is gradually cooling, at least in the eyes of the San Francisco Fed president, Mary Daly. I know in the last video we were talking about that, and that rate cuts are just diminishing in terms of how many we are expecting. People have different perspectives because a lot of economists are looking at metrics like this, but then you go in the grocery store and it might feel otherwise. So then the final thing is that now the Fed is expecting just one rate cut for 2024. I believe at the beginning of the year we were anticipating 6. So this is a pretty drastic difference. And the first one is expected to be a 25 basis point interest rate cut, and that would be in September. So going into Q4 of 2024. Some of the markets, though, are expecting 2 rate cuts, so we'll just have to wait to see how that turns out. But moving into the French election. So this is a really interesting situation, which kind of is very contradictory to what's going on in the UK. So some time ago, President Macron called a surprise snap election. So that meant it had to move quickly. It is coming up, or it has already started and finishes July 7th. And this so far has caused some extreme market volatility just because people don't really know what's going to happen. Someone from Goldman said that markets are finding it so difficult to price in that there's not a clear path to a great outcome for markets. The key concern in the elections and all over the world is France's high debt level. They have run large budget deficits without much pressure to control finances, similar kind of to what we're facing here in the US. A lot of the elections so far, the polling has shown that it's going to be a pretty big shift to the far right. So like I say here, it faces a potential political shift with a snap election that could bring the populist far right to power with high spending, anti-EU policies. So it'll be really interesting to see how that plays out. And you can see here just how the French sector has differed compared to the EU. So really not doing the best in the world, and hence why you could imagine some shakeup is coming. Next up, going into the Shein potential IPO. And again, I think it's pronounced that way. Looking at it, I would say Shein, but I think I've heard more people say Shein than anything else. And they are looking to go public in London. So if you're not familiar, Shein is a popular fast fashion retailer, but it has faced some significant obstacles in its path to an IPO. It's gotten in some hot water just because of some allegations about child labor and just poor working conditions of their employees, and which makes sense because of how cheap they make their clothing. There have also been things talking about slave labor. I'm not super familiar with it, but there are just a lot of concerns, not just on that end, but also due to just general US-China trade tensions. That is similar to what we're facing with ByteDance. They have a crazy high valuation, but because they're affiliated with the Chinese government, it does create a little bit of a conflict there. So with that going on in the US, Shein did confidentially file for a listing in London. However, its proposed IPO is getting pushback from some British politicians related to concerns over the fast fashion giant's labor practices. So similar to what Shein is facing here in the US, it is still an issue over across the pond too. And so because of that, as a result, the setback may cause a Singapore-based corporation to reconsider its initial preference for New York, given its growing prominence in the United States. So what I mean by this is because they're getting that pushback in London, they might decide that it's worth it to just go to New York, whatever. If investors or if certain people want to give them a hard time, who cares? The oil industry has certainly gotten a hard time over the years, and they're still up and thriving. So we will see what they decide. And of course, Shein is huge here, so there is just more of that prominence. It's much more well known amongst investors, if they have daughters, if they have children. And so it kind of makes sense. But both exchanges have courted the company, but we will have to wait for further information with federal securities authorities making the final call. So again, this is a super regulated space in terms of who is allowed to go public. But the argument could be made that it could be a good thing for the company, for investors, for geopolitical tensions, just because as a public company, a company would be under more scrutiny, and we'd be able to get a better inside look on the labor practices, on the finances, on their affiliations with certain governments, which I think is a win for everybody who is nervous. Going back into geopolitics, we have the UK election, which has so far put private equity and venture on edge, and this is because of their regulation around carried interest. So UK private equity and VC investors are bracing for potential upheaval as British voters are expected to vote out the Conservative Party on July 4th, ending their 14-year rule. So that's what I was alluding to earlier. It's really interesting. We're seeing the shift to a more conservative in France, but in the UK, the Conservatives are getting a bit pushed out. So far, the Labour Party leaders have pledged to raise the tax on carried interest from 28% to a whopping 45%, arguing it should be taxed as a fee for service rather than a capital gain. This change, however, could exclude general partner contributions. I'm not entirely sure how that works. It's a little bit more technical, above my foray, but I'm sure we'll learn more about it as time goes on. But anyway, the Labour estimates the policy could generate £565 million in additional tax revenue per year by fiscal year 2028, although this figure may decrease if investors flee the country. That makes sense. If there's really bad regulation, then why would someone want to stay there when they can get a lower tax rate on their carried interest elsewhere, especially at the valuation that some of these firms are getting in terms of the income? A difference of 17% could be tens of millions of dollars. And so it kind of makes sense that people would want to leave. And then therefore, this would be a net loss for the government in terms of the money that they can bring in. So that's a classic issue that we see where is the juice really worth the squeeze? I guess we'll just have to wait and see. But like I say here, historically, carried interest tax fights in the US have ended with private equity maintaining favorable treatment despite campaign promises from Obama, Trump, and Biden. And also the UK had created a special tax category for carried interest in 2015. So it presents a different battleground. And in case you're not familiar, carried interest is the interest that a specific individual would have in their fund. So as it's more relevant in terms of private equity and venture because those investments typically take time. Private equity, the investments sit for 5 to 7 years. Venture can even be longer depending on the vintage. And so that is where the real money is made as a company scales and grows and the private equity firm is able to exit. The carried interest that a partner at the firm may have is their percent in that actual sale. And so taxing that is similar to capital gains. It can make a huge difference in terms of your actual payout and also just the profitability of an investment for the firm. So will be really interesting to see how it plays out. So far, or I should say last year, UK-based funds raised nearly £60 billion, with private capital investments in UK businesses exceeding £20 billion. The private equity-backed M&A activity has surged over 68% this year, making the election results crucial for future investment trends. This is interesting. 68% increase. Are people trying to get all their investments done now, and so they can go to a different country but still have the investments in place? We will see, but I think it is an interesting problem, but again, something that only affects the absolute top of the top. Speaking of the top of the top, the Pershing Square is looking to go public. This is Bill Ackman's hedge fund, the one he started back in the day. It has certainly seen some trials and tribulations, but they are on top right now. Pershing Square USA, the hedge fund managed by Bill, is closing in on an IPO set for 2025 or 26 on the New York Stock Exchange. The fund is currently valued at $10.5 billion based off of how they are pricing per share. The fund is expected to list the shares at $50 each, and with investors needing to have a minimum 100 share count, making it a $5,000 investment. Pershing Square USA will look to have a similar fund structure as their European fund, because Pershing Square is actually already listed elsewhere. But the way this works is it's not fully, the shares don't compile 100% of the equity of the firm. So although it's valued at the 10.5 billion, that's not the full amount that would be bought in the public markets. Bill obviously is going to be doing just fine. And Pershing Square is well known for investing in 10 to 15 large market capital companies. The strategy has proven to be effective so far, and they yielded a 26.7% return in their last fiscal year. And of course, we all know Ackman is quite the billionaire, so it looks like a cool opportunity. And with that, that is going to wrap up the video. I hope you enjoyed this last week on Wall Street. I can't wait to see what this next week has in store. As always, if you have any questions at all, feel free to reach out to me on LinkedIn, and I'll see you in the next video. Peace.